Hey guys, Eric here, Mr. Fired Up Wealth. Hope you're doing well. And today I'm going to bring you my top 20 picks for 2020. Now, I don't want you to watch this video and just go out and buy all the picks and come back and say, why didn't all these picks go up? Do your own homework, do your own due diligence. These are 20 stocks that I think are good ideas for you to investigate. I think they have potential to outperforming the market in 2020. Obviously, you can't predict the future. A lot of things are going to be relying on that between the trade war, presidential election, impeachment, all these different all these different political and macroeconomic things that are happening in the world. So based on the situation today is December 20th, 2019, I've identified 20 stocks, and I'm also going to cover 10 high-risk speculative bonus plays at the end. So this video is going to have a total of 30 stocks for you to investigate that I think could be a good play for 2020 and probably beyond. So sometimes the timing's not perfect. You buy it in 2020 and it could end up taking off in 2021, but all these have some really good stories. What I'm going to do at a high level is just give you my list of 20 top stocks for 2020, and then the 10 bonus high-risk speculative picks, so the 30 picks. I'm going to go through those at a very high level, and then what I'm going to do is I'm going to work with you through comments, through our Facebook group, the Fired Up Wealth Facebook group, and I'll determine which stocks I'm going to create individual videos for. Now, some of the stocks that I'm going to cover today already have videos, and I'll try to put up some links in the video so that you can actually click and go to other videos and see what I've already covered on some of these. So without further ado, let's go ahead and jump into this. So number one is Amazon. And the thing about Amazon is it should have some really strong earnings from the holidays. I think that AWS will continue to grow. And I think that overall the market has performed better than Amazon. I think that Amazon will probably do some catching up in 2020. There's several analysts, which doesn't mean anything. Trust me, analysts are oftentimes wrong. But the Cohen analyst, John Blackledge, he's saying outperform in a price target of 2,400 and a best idea for 2020. I've seen several other analysts come out and say the same thing. So I was buying around under 1750, and I'm thinking that this is probably going to trend up towards that 2200, maybe even as high as 2400 mark. There's always a chance that doesn't happen, but this is one good pick. Second one on the list is L3Harris Technologies. Now, L3Harris is a defense stock that's focused on technology, pays about a 1.5% yield. And the merger was completed in, I believe it was around mid-2019 between L3 Technologies and Harris. Both were defense manufacturers. Now, I believe the combined company now is something around the fifth or sixth largest defense company, defense stock. And what I like about them is they're focused on technology. So take a look at L3 Harris Technologies. I think that one could be a very good play. I think that this merger has happened between the two businesses, and we should start to see some production. I think that this company could flourish in 2020. NVIDIA is a top pick for me. I'm looking at the Fibonacci retracement to the $338 mark. I don't know if you're on the Facebook group, you've probably saw a post about NVIDIA, but basically this stock got crushed, and there's a Fibonacci chart that basically shows that this could go back to 127.2%. So essentially what that is going to take you back up to the high, and then in 27.2% in addition to that. So $338 is the price target on this one, which is about 45% higher than where it's trading now at $239. Will it happen for sure? Nobody really knows, but I think that's a good chance. This entire theory goes out the window if this price drops. I believe around 225 is the floor right now. So if it starts dropping down there, that could break down, and this entire theory goes out the window. So ignore it at that point. The next stock is the Trade Desk. I have a video that covers why I like this one. The video is called Top 5 Artificial Intelligence Stocks. It's off the radar intelligence stocks. It's the one where my thumbnail looks like a robot. take a look at that video, and you can get more information on Trade Desk. The reason I like it primarily is because basically with Amazon, you're going to be able to do some advertising, and I think you're going to see a huge increase in numbers for this. It's a great growth company. It's up 116% already this year, 52-week performance, and I still think it has room to run and a good chance to outperform the S&P 500. The next one is ServiceNow, and I've covered ServiceNow on a couple of, well, at least for sure, I covered it in my top 5 cloud stocks video. So take a look at that. Obviously, it's cloud related. It's a very good company. It's up 60%, 52-week. I think it has quite a bit more room to run. It's one of my top holdings in my taxable portfolio. Alphabet, Google. Think about this one. 52-week performance is 31%. The PE on this thing is 29. I also cover this one a little bit more detail on my top cloud stocks video. I think at some point it's going to fly, and that it's a little bit undervalued. 29 PE ratio is certainly not too rich, considering that the overall market is around 20, and that the technology that this company owns is just tremendous, between Waymo, between YouTube that you're watching right now, and tons of other things that you may or may not even know exist. So take a look at this company. There's 2 different tickers. There's GOOG and there's GOOGL. I prefer the GOOGL. It's just a difference in voting, difference in type of shares. Doesn't really matter which one you trade. I just prefer the GOOGL. Next one, Salesforce. If you've watched any of my videos or followed me, you know that I'm big on this stock. You can certainly take a look at the top 5 cloud stocks and get, I think, probably 10 minutes worth of information just on that video alone. Like the management a lot. They're still in hyper growth mode. It's an expensive stock, but they're trying to double their revenue, and I think this is going to keep growing. If you look down here in your earnings, they've beat 3 quarters pretty, substantially. 32-cent beat, 19-cent beat, 8-cent beat. This is a good one. I think it continues to go higher. It's kind of had a little bit of a pause, and I think it's about ready to go back upwards. This is one I haven't covered yet, and Autodesk. I'm really excited about this stock and this company. I'm going to be doing a video just about this one, but this is very exciting. I think it could be a top pick for the next couple of years. If you're familiar with Frozen 2, the technology behind that is Maya. It's the Maya platform, which Autodesk owns. It's actually an animation software, and I think that just their AutoCAD growth alone is impressive. But I think with Maya that this could be something very big over the next few years. Cisco Systems. This is a tremendous value play right here at 19 PE ratio. Almost a 3% yield, and there's this, I cover this one both in my 5G as well as my cloud videos. I love the opportunity here. There's so many secular growth trends that Cisco falls in, between cybersecurity, between 5G, between cloud. I think it's a great company, especially with the yield, and I do think that it's a fairly safe pick in this price range, something that you can probably get a pretty good return on, so it is on my top 20 list. Next is Xilinx. Now this one is a high risk, sort of high flyer type of chip stock, and you can see that it was actually $141 at one point, and it's down to under $100. I think there's a good chance that this one could go back into that $140 range, especially with the trade war calming down. This is all about 5G. It's about MIMO boxes, and I cover that one extensively in my 5G videos. So if you're interested in more information on XLNX, go ahead and take a look at the 5G video. It's only up 13%, 52-week. I think this one has some good room to run. It's trading at about 25 PE ratio, but it also pays a 1.5% yield. This is one that I do like, and I think will be a good long-term play, not just in 2020, but you could hold it for the next 5 years. PayPal Holdings, this one was tough, and really you could take PayPal, Square, and Visa, and you could, all 3 of those should be on this list. But instead of doing all 3, I figured I'd talk about Visa and Square when I talked about PayPal. MasterCard could even be thrown in there. Either pick your favorites of that group or buy a little bit of all of them. But I don't really think you can go wrong with fintech. And I think PayPal has been kind of beaten down. It was $121. It's back at $108. I think at some point we get past that $120 mark and push upward. I mean, It's a good company. They're doing a lot of good things with Venmo. It's relatively expensive where it's at. Doesn't pay a yield, so some people might want to go with the Visa route and get a little bit of yield. Maybe even MasterCard. There's also Discover Financial Services. But have some fintech in your portfolio. Do some research on the different ones and see which one is the best fit for you. Twilio is the next one, and it is cloud related, potentially a rebound play here. It was a $150 stock in the summer of 2019, and we're trading at $100 a share today on December 20th, 2019. They obviously, they basically projected slower growth, slower earnings, and on a stock like this that has a sky high valuation, when you do that, it's going to bring the stock down hard and fast, which is what happened. But I do see this as a rebound play. It was as low as $73. That would have been a tremendous buy. That was about this time last year. But at $100, I think it's a pretty decent play, and upside of 50%. Over the next year or so. So take a look at it. There's no guarantees there. It's very bearish right now, but I do think eventually this one catches fire and starts to catch back up with the broader market. Next one is Tyson Foods, and I like this stock. I have for a while, but especially now because with the most recent trade negotiation between China and the U.S., we can now ship chicken, which we couldn't. It was basically banned, shut down by China, and essentially now we can be shipping chicken back to China. So I also like the potential for pork because you might know Tyson for chicken, but they also, if you look at their brands, they own several other big Hershire farms, I believe, but they do have a very large pork production. It's one of the largest for a publicly traded company. And China, of course, with the swine flu is having some issues there. So I do think that we start to send more agriculture and farming and meats and things like that. I do see Tyson being a good play, not only in the U.S. because everybody loves their protein, but I think China could be a huge play here. 16 PE ratio, a 1.87% yield. It's definitely one that I'm holding for the long term. Medtronic. Now, this is a good company. It's all about medical devices. It does pay a 1.9% dividend yield. This is really a play on robotic surgery, and this could start to catch fire probably later in 2020. They're doing some clinical trials right now and competing against Intuitive Surgical on robotic surgery. That's called Hugo. That's their robotic surgery group, and it's not available for sale. They're doing some clinical trials. I believe that they're trying to launch that as early as 2021. So knowing the stock market, usually the stock market is ahead of actual events. So I see this probably starting to catch some fire maybe at the back half of 2020. So put it on your radar for something that could potentially have some good growth here in 2020. It's a 32 PE ratio. Like I said, 1.9% dividend yield. It's one of those safer picks that has some good upside growth potential. U.S. Bank Corp. This is another one that's going to be, it's a Minneapolis-based company, has good management, a 13 PE ratio, 2.8% dividend yield. It's one of those safer plays. It's not going to be an extreme growth play on this list, but I like the company a lot. I like financials, and if you want to be in financials, this one has a 13.83 PE ratio with a 2.8% dividend yield. Very solid management, know the company very well. Used to live in Minneapolis for about 20 years. So take a look at U.S. Bank, that's USB, as a solid potential play for 2020. Carnival Cruise Lines, it's kind of funny. I've been buying this one earlier this week before earnings. They had earnings today, and the stock was up about 7.5%. Of course, then two Carnival cruise ships off of, I think, Cozumel ran into each other. Literally just happened 10 minutes ago. And now the stock is pulling back a little bit, but it's still up over 6%. And it does pay a 4.5% dividend yield, guys. And the 52-week performance is negative 18.66%. This is one of those pretty attractive value plays. It's inexpensive. There's actually two different tickers. There's either CUK or CCL. Of course, I picked CUK because my last name is Chuka, spelled CUKA, so it made sense. But there are just some minor differences. You can look on their website and figure out what the differences on the tickers are. I like this company. I like Shaquille O'Neal endorses them now as one of their spokespeople. I would much rather invest in Viking Cruise Lines, but it's a private company. And, You've got Royal Caribbean and Carnival. Both of those are good. I just like Carnival at this price point with the decent yield. So I've added some of that. I probably should have added more, but I might still add some more because I do think, again, that this has upside potential. It was a $58 stock trading at 47. It could easily be a $60 stock in 2020 if things go well for them. They'd have to stop running into each other and, hurting hurting tourists, and then maybe the stock can continue to go upward again. Caterpillar. So this is all about if we truly are entering a new growth cycle globally, then we need CAT's machines to build, housing, commercial development, infrastructure, all need machinery that Caterpillar manufactures. It's one of those fairly safe, attractive, well-established companies with a 13.79 PE ratio, a 2.8% dividend yield. It's trading at a 52-week high, 18%. It's been as low as $111, which would have been a really good buy. You could have bought it in October for under $120, and you would have looked really smart. But I do think that this could still have a lot of room. It's going to be one of my safer picks that has yield. It's not going to be one of the higher growth stocks on this list, similar to US Bank, but I wanted to add a little bit of value into here and not just have all high flyers. You got to have some balance. And this one's a good balance, has a good yield, and still has potential, I think, for some upward growth. This one I've liked for a long time, Splunk, and it's cloud and data management. They're getting more into cybersecurity, which is really what I like them for. They're up about 50% over 52 weeks. I do think this is going to be a great long-term play. I plan on holding this for quite a while. Take a look at Splunk. Viacom CBS, recent merger. I bought CBS stock before the merger, and now it's Viacom CBS. It's ridiculously inexpensive. It is trading at a 5.43 PE ratio, according to Fidelity here, with a 1.72% yield. It has a negative 7.5% 52-week performance, and it's just too cheap to ignore. This is one of those value plays. It's the content is just too good to ignore at this price. They own CBS, they own BET, they own Comedy Central, Nickelodeon, Paramount, Showtime, Smithsonian Channel, VH1, others, but some really good content there. And you think of Comedy Central and Nickelodeon for the kids, and then Showtime. A lot of people like Showtime as a lot of people think that HBO owns Showtime, but they do not. It's Viacom CBS. Take a look at that one, guys. And then the last one, number 20 on this first list, is going to be BMY, Bristol Myers Squibb. Now, I've been a Celgene holder for a while, which had some ups and downs. It's one of the Celgene was one of those hyper growth, high risk stocks that focused on cancer drugs. Bristol Myers Squibb didn't really have an excellent pipeline. This is very similar to the AbbVie story. The difference is that this story was embraced right away. AbbVie, the stock got crushed. Everybody said it wasn't going to work with their big merger, and now AbbVie is like everybody wants AbbVie, and it's great. Well, that's awesome for me because I bought it when it was 30% lower, and I'm still getting a 6% yield on it. Bristol Myers Squibb, though, it's 18 PE ratio, 6% dividend yield. And as I mentioned, they acquired Celgene this year in 2019, which has an excellent pipeline. It seems very positive that a lot of these clinical drugs will actually get approved by the FDA. And I feel like it's a semi-safe play. It certainly could, go back to the $45 range or something if one of their drugs fails. But this also has potential to be a $75 plus stock, and it has a solid yield. So keep an eye on this one, guys. Bristol Myers Squibb. All right, guys. So next I'm going to cover 10 high-risk speculative plays. Now, I want you to hear this. These are high-risk speculative plays. These could double. They could lose a lot of money. So I don't want you to invest in these unless you know what you're investing in. Make sure that you're doing your homework and make sure that you realize when you're investing in these stocks that you could lose your money. And if you're not comfortable with that, do not invest in these stocks. The key, I always have a lot of these types of stocks in my portfolio. And the reason I do it is to help me outperform, and I sell those profits and I buy dividend-paying stocks, DGI stocks, dividend growth investing stocks, companies that increase their dividend on an annual rate. I buy those stocks with profits, and I'm going to use that to retire early and to live off dividends. So I'm using growth to accelerate that so that I can basically get more money faster. Now, the key when you have these high-risk speculative plays is you don't want to just go pick one and say, that's my horse. That's basically gambling. So, it's basically gambling because your horse most times does not win when you're watching a horse race. So the nice thing with stocks is that you can really hedge it. Let's use this as an example. Let's say you have $20,000 and maybe the number is much smaller. Let's use $10,000. You have $10,000 and that's a portion of your overall portfolio. So you have a $200,000 portfolio and you want to put $10,000 of it in a high risk speculative type area to try to help outperform. What you would do is you would buy, $1,000 worth of each of these types of stocks. I'm not saying go take my 10 stocks, but this is an example of these kind of picks that would go into a high risk basket. You'd buy, say, 10, maybe even 12, maybe 15, but let's use 10 because it's really simple and round. You buy 10 of these stocks, $1,000 in each stock. So you got $10,000 invested. The goal behind it is you want a couple of these to maybe double, maybe 100%, 80% type gains, maybe even more. The most you can lose is 100%, but you have infinite gain. You can gain 10,000%, which is unlikely, but it's possible. If you look at Amazon or Netflix, if you had invested even Apple, at the very beginning and held it for years and years, you see these crazy returns. But some of these companies literally can look at Shopify. Look at Roku. Roku had a 300 and some percent return just in 2019. If you can get a couple of those horses that have a 300% return, it's unlikely that any company is going to go out. It could go out of business and go to zero, and then you have out of your $1,000 investment, you have zero. Hopefully, before that, you would sell. You would sell when you're down, 30%, and you'd only lose $300 out of that 1,000. But let's just use worst case scenario. Let's just say you bought 10 stocks. One of them goes to zero, and 3 of them increase by 300%, which is also unlikely. What I'm trying to do is tell the story, though, that you're still going to be way ahead. And even if you have 2 that are 100% gainers, you have 5 that just are 20% gainers, and you have 3 that just, do really bad and they're down 30, 40%. If you do that math, you're still up, 30, 40% on that basket. You're outperforming the S&P. If you get lucky, you might pick 10 winners that are all, one of them's up 20%, one's up 50%. The rest of them are all up 80, 90, 100%. That could happen. And now you could take $10,000 and all of a sudden it's worth $20,000 in that 1 year. So that's the kind of strategy I play. It's hedging risk. It's, trying to not put all my eggs in one basket and to try to get into some of these hyper growth companies. So make sure you play these carefully and try to use an approach like that to make sure that you're not just, throwing all your eggs in one basket and losing all your money. I get really, I get saddened, I guess is the best word. When people come to me and say, I bought this stock, I bought Aurora Cannabis at $6 and now it's trading at $2.50. What do I do? Well, you have to know that these kind of stocks, like cannabis stocks, they're high risk and they can lose money. You need to be able to hedge it. And so say you want to be in cannabis stocks, maybe you put this in this high risk basket, and out of the 10 stocks, maybe 3 of those stocks are cannabis or pot stocks. And the other 7 are different tech, health tech. There's different sectors you can go into. So anyway, let's jump into it. Here's the 10 high risk bonus picks that you could look for your high risk kind of bucket in your portfolio. This one is really interesting. It's called Ping Identity Holdings Corp. And the IPO launched in September of 2019. It's intelligent identity solutions. It's like single sign-ons, API security, data governance, things like that. They've only had 1 quarter. They beat by 12 cents, it looks like, a share. And it's one of those that could easily double, and it could go, it could go a lot lower too. But take a look at it. I mean, you can see that it opened, it's gone up quite a bit already. $15.22 to $24.49 as a high. So take a look at this one. It's one of those high risk, high reward, high flyer type plays that you might want to invest in. Next one is PaySign Inc. Now this one is up 198% just in 2019, which is part of the reason it's on this high risk bonus play. This is one that I played with in 2019 in my high risk play. And I think that it actually could continue. And the reason I think that, it actually was $18.67. So it could easily go back to that, and it could go up, it could go up 50%, maybe more from the $10 range. It could go down too. It could go down to $3, which is what it was last December. So you want high risk, you want high reward, you want to see how people, can make or lose money. This is one of them. It's very bullish, 9.2 sentiment on the equity summary score. They've beat earnings 3 quarters in a row, but it's up, 200% this year, and it's a 92.64 PE ratio. So tread at your own risk. High risk, high reward. This is a really interesting one too. Trupanion Inc. Now, what these guys do, first of all, they're up over 50%, 54.8% in 2019. I've never invested in this company, but it's one that I've watched and I've stumbled upon. I think the idea is really interesting. It's pet insurance, and people love their pets. They spend money on dog food, on clothes, and dress up their little, poodles and stuff. Why wouldn't, a young person especially that doesn't have a ton of disposable income or savings. If I've had dogs that had to go to the vet. The dog I own now, I've spent $2,000 on more than one occasion for tooth extractions and surgeries. So I mean, you could have an incident where, depending where you live, I don't live in an expensive area. You can live in San Francisco. You might have I'm not even joking. You could have a $4,000 or $5,000 dog bill and you don't have the money. So what's the solution? Well, Trupanion. Trupanion will allow you to actually have a monthly subscription plan, which is inexpensive and you can afford to pay monthly, that will cover you in the United States, Canada, and Puerto Rico for, if your dog or your cat or whatever, needs medical care. So it's an interesting business model. I like the business model a lot. It's very high risk. Anybody could just come in and basically compete in this space. So, I mean, what am I investing in if I buy a Trupanion? Is there brand loyalty? I just don't know enough about the company, but I really like the idea, and it could be one of those speculative plays that you could take a look at for your high risk bucket. StoneCo, this one's up 116%, and a lot of you might know StoneCo because Warren Buffett actually owns some of it. It's a Brazilian fintech, and what they basically do, is so they have mobile channels in Brazil. It's financial technology solutions that empower merchants to integrate partners to conduct electronic commerce. It's basically, it's a credit card provider payer in Brazil, and it's expensive, 67 PE ratio. They do the technology solutions for digital merchants and sales and technical, personal, and software vendors. I don't know a ton about this company. I haven't owned it. I actually have traded it several times. I've made some good money just doing day trades and things like that. But take a look at it because it's up 115%, and a lot of people still love this one, and they think it can go a lot higher. It was once $45. Could it go to $50? It might. Teladoc Health. Now, there's a few guys in our Fired Up Wealth Facebook group, and if you're not on there, you need to go on Facebook right now, type in Fired Up Wealth. There's a page, but there's also a private group, and that's where we really get down and kind of talk about our portfolios. And that's what's meaningful about this whole Fired Up Wealth group is it's not just the videos, it's the fact that we can all communicate with each other in Facebook. And we can communicate in the comments and in YouTube as well, but it's not the same. It's not nearly as interactive. So I encourage you to join our group. I think we have about 700 people. We're pretty selective. Not everybody gets in. If someone's in there spamming and things like that, if they don't answer the questions, they don't get in. But this is one where there's several people that are in their 30s or so that have brought this one up. It's up 70% this year. The idea behind Teladoc is pretty cool. It's virtual healthcare. It has huge potential. The thing about it is the competition, the threats there kind of worry me a little bit. It's kind of like the last one with Trupanion. What are the barriers of entry for a company like this for someone to come in? And I haven't done enough homework. This is one I might do like a separate video on and just dedicate 10 or 15 minutes on this one company because I haven't really dug into it as far as I'd need to. But it's one that I have on my radar, and it's one that easily could be in that speculative bucket for us. DocuSign's another one, and that's been around for a while. Cloud-based e-signatures. My company uses it actually to do all of our electronic signatures for documents and for purchase orders and MSAs and NDAs and all that fun stuff. But it's up 79%, year to date, 52 week. It's a $13 billion medium cap. it could easily, go a lot higher, and it could easily, go a lot lower. It was $36 a year ago. It's 76 now. One to put on the radar. Okta, I like this one because it was already $141 stock. It kind of fell from, fell from the sky a little bit, but it's still up 85% over 52-week performance. If you don't know anything about Okta, they do identity solutions for enterprises. It's cloud-based. It's one of those cloud princes, they call it. Take a look at it, though. It does integrate well with a lot of the big boys. And I think this one, I don't own any of this. I did, and I sold it. I'll probably buy some of it back. I think that there's room. I was hoping for a dip. I'll be honest with you. I was hoping for a dip under 100, but it doesn't look like that's going to happen. CrowdStrike. I actually owned this one for a little while, made some money and sold it. You can see it kind of took a nosedive. But I do like this company. It's cybersecurity. It was a 2019 IPO. It's one of those IPOs that I made a lot of money on and kind of got out of it like fastly. It was $101 and it dropped to 50. So I'm glad I sold this one. But I do think that it's one of those companies where it falls on its face and then it works itself back up into that valuation. So I don't know if it's going to happen overnight or even 2020, but they're doing good things. They're not profitable, negative 7 cents earnings a share, but I see this one being back in that $100 price range. Maybe not in 2020, but in the next 2 to 3 years for sure. So it's pretty safe, not safe, but it's pretty good growth here. And it's one that I would, throw into a speculative bucket, and it'd be out of all the other speculative plays that I've talked about so far. This is probably one of the better ones. It's a $10 billion market cap. It could go lower, but it could also go quite a bit higher. The next one's Cloudflare, which is very similar to the last one, and then like a Fastly. And Fastly could be in this list too, but there's some reasons it's not. I would avoid that one right now because if you're going to play in that space, I would go with Cloudflare. That is, cloud, Internet of Things, security. It was a 2019 IPO, pretty recent in the last few months. $5 billion company. This could be a long-term winner. And the last one, guys, I actually covered Viva Systems in my artificial intelligence video. So there's a few videos I would check out after this one. There's the top 5 cloud stocks. There's the top 5 5G stocks. And then there's the artificial intelligence off the radar picks. I like all 15 of those picks still, and a few of them have been beat up, and Viva's one of them. I like Yext is on that list too, where it's been beat up a little bit. But Viva Systems, watch that video because the people running this company, I believe in. They have a track record from PeopleSoft to Salesforce to now Viva. This company's been around for a while, and it is expensive at a 72 PE ratio with a 60%, 52-week performance. But they consistently beat their earnings every quarter. You can see down there 5 cents, 6 cents, 6 cents. The sentiment is still bullish on this one. And the reason I like it, it was $176. I think it's going to get back to there. The reason for it is biotech is heating up again, and that's what these guys really do. They're cloud-based software for life sciences. Life sciences being, mostly biotech type companies when they're releasing drugs and things like that. This is the software solution that helps them get to the finish line. So when biotech is heating up, you're going to see a lot of those smaller companies growing, and they're going to have to change their enterprise, systems, how they do business, and going, to more elaborate platforms within their software systems. So I think you're going to see an increase in Viva Systems in terms of sales. It's a $20 billion company. It does have a little bit of a handicap because the fact that it really is focused in life sciences, but life sciences are very, they're very cyclical and they go up and down. And right now we're kind of on an uptrend. The IBB, which is the Biotech ETF, I think it's a record for the consecutive weeks that it's actually been up. And I think with that, you're going to see more spending. You're going to see companies like Viva Systems benefit now, and you're probably going to start seeing that in the earnings in 2020. So hope you guys like these 30 picks. You've got 20 picks that are, like some of the big boys, blue chips. And then I gave you 10 high-risk speculative bonus plays. So you got 30 picks. I want you to do your homework on these. let's start a discussion in these comments below. And if you are on Facebook, certainly go to the Facebook website, or not website, but group, Fired Up Wealth, and join our private group, and we'll continue the conversation there. But appreciate you watching this video. If you haven't subscribed, please do. Bottom right corner, click it. There's also that little bell you need to click. I want to make more videos from this. I would guess that there'll be at least 5, 10, maybe more videos from this video. A lot of these companies I've already covered in detail, but the ones that I haven't covered, the first one I'm going to do is Autodesk. And I'm going to actually do, in-depth analysis on some of these companies. If there's a stock that you want to see more analysis on, please drop it in the comments below. Please stop by the Fired Up Wealth Facebook group and let me know, and I will take that into consideration when I'm making my next video. So appreciate your time. Hope you have a great weekend. Have a great rest of your day. Take care.